Thanks for joining me this Friday, the 22nd of August, for our next reporting season video in this coverage for August 2025. I'm Grady Wolf, Senior Market Analyst with Bell Direct, and this is also our weekly market wrap. So for this reporting season so far, we have seen 90 companies report, with 19 beating expectations, 41 meeting expectations, and 30 missing expectations. 22 companies have been upgraded by brokers, while 22 have also been downgraded by brokers. Let's dive into the big moves that moved markets this week and the results that moved markets this week. The strategy shift to data center expansion for Goodman Group, ASX GMG, was a key driver of the company's return to profitability in FY25, as results out this week unveiled. For FY25, GMG reported statutory net profit recovered from a loss of $98.9 million in FY24 to a profit of $1.664 billion in FY25. Operating EPS came in at 118 cents per share. That was up 9.8% on FY24. Distribution of 30 cents per share was declared. Net tangible assets per security rose 25% to $11.03, while gearing fell to 4.3%, indicating financial strength and flexibility in the capital-intensive industry. The development pipeline remains robust for Goodman Group as well, particularly in data centres, which now account for 57% of work in progress. Stabilised data centre capacity increased to 700 megawatts, with a secured pipeline of 2.7 gigawatts. Despite FY26 EPS guidance of 9% being slightly below consensus, it is viewed as conservative, with the expectation of upgrades throughout the year consistent with Goodman's historical pattern. The group's expanding data centre and global data centre strategy and strong liquidity of $6.6 billion position it very well for continued growth into FY26. Household name Bega Cheese, ASX BGA, also impressed investors this week with solid FY25 results, as investors sent the share price of the dairy maker's shares up over 8% on results being released. BGA delivered a strong financial performance in FY25, with normalised EBITDA rising 23% to $202 million, and that was driven by growth in branded product volumes, including white milk, yogurt and spreads, successful new product launches and disciplined cost management. While statutory earnings were affected by restructuring costs from major business improvement initiatives, these moves, such as the consolidation of cheese processing and the exit from juice and peanut operations, strategically position the group for long-term efficiency and profitability. The bulk segment of the company returned to profit, contributing significantly with a $56.9 million turnaround in EBITDA. Additionally, Bega improved its balance sheet by reducing net debt by $36.3 million and cutting its leverage ratio to 0.8 times. With strong market positions, growing food service and export demand, and ongoing focus on brand innovations, Bega declared a fully franked final dividend of 6 cents per share and expects further earnings growth in FY26. The group provides guidance of normalised EBITDA in the range of $215 million to $220 million for FY26, signalling a second solid year is on the cards for the dairy maker. On the theme of dairy, A2 Milk, or ASX A2M, also met expectations in FY25 results, prompting some brokers to upgrade it to a buy. Highlights included record sales of $1.9 billion, up 13.5%, a 24.8% rise in net profit to $192.1 million, and a 20.9% lift in EPS to 28 cents per share. EBITDA margins rose 14.4% and the company holds over $1 billion in net cash. However, FY26 guidance was cautious, with flat earnings expected at A2M as the company sells its Matarara Valley stake and acquires the Pocono facility, moves that may reduce revenue short term but boost margins in the long run. A $300 million special dividend is also planned, but rising capex and near-term losses from Pocono have kept the market quite cautious, with the stock trading at a current 32.3 times FY25 earnings. And being an unhedged gold miner in FY25 shone pretty bright for investors and resulted in stellar results for the likes of Northern Star Resources, ASX and ST. For the last financial year, Northern Star posted a record underlying free cash flow of $536 million, up 16% from FY24. This was driven by a 60% rise in underlying EBITDA to $3.5 billion and a remarkable 105% jump in underlying net profit after tax to $1.4 billion. FY25 revenue soared 30% to $6.4 billion, supported by a 29% increase in the average gold price to $3,922 per ounce, alongside the sale of 1.63 million ounces of gold. However, costs also rose, with sales expenses climbing 11% to $4.1 billion. A final dividend of 30 cents per share, up 20% from last year, was declared, reflecting strong cash flow and profitability. Northern Star's balance sheet also remains pretty robust, with net cash of $1 billion and liquidity of $3.4 billion. The acquisition of De Grey Mining also bolstered its portfolio and growth potential, with many in the industry and many leaders envious of the addition of Hemi Gold Project to Northern Star's portfolio. Looking ahead, Northern Star expects to sell between 1.7 million and 1.85 million ounces of gold in FY26, with all-in sustaining costs projected between $2,300 and $2,700 per ounce. The company remains focused on its growth strategy, and that includes advancing the Hemi Gold Project, while also managing rising production costs and the challenges of volatile gold prices. So, what have we learned this week and in the reporting season so far? Earnings growth has been slowing across the board, aside from gold miners and those niche areas of the market. On the bright side though, FY26 is shaping up to be a stronger year for most sectors, with strong guidance outlook. Cost management is essential to ensure margin pressures are overcome in FY26. Retailers yet again remain resilient despite many headwinds being faced for the sector. Investors exposed to data centres are in a strong position to benefit from upside growth in FY26. And a return to profitability for some big names has been welcomed, with strong share price appreciation, but outlook for FY26 still governs investor reactions. Locally, from Monday to Thursday, the ASX 200 posted a 1.64% gain as major average reset its record thanks to a more than 5% surge for consumer discretionary stocks, closely followed by the financial sector rising 4.5% over the 4 trading days. The winning stocks on the ASX 200 were led by Centuria Capital, rising 21%, and Super Retail Group climbing at 16%, while James Hardie Industries ended the week down over 36% on poor outlook for FY26. On the broader market index, the All Ords rose 1.48% as Weebit Nano soared 33%, while FBR tumbled 25%. The most traded stocks by Bega clients over the 4 trading days this week were led by Amplitude Energy, CSL, Regal Partners and Woodside. Clients also bought into BHP while taking profits from Westpac, NAB, ANZ, Macquarie and Wesfarmers. And the most traded ETFs by our clients this week were led by Beta Shares Australian Hybrids Active ETF, Vanguard MSCI Index International Shares ETF and iShares S&P 500 AUD ETF. On the economic calendar front next week, we may see investors react to the latest meeting minutes out of the RBA to be released on Tuesday to gauge the outlook for further rate cuts in Australia. While overseas, key US PCE, personal spending and GDP growth rate data will be out later in the week. And on the reporting season calendar next week, as we wrap up this reporting season, we'll see results out of Adairs, Domino's Pizza, Fortescue, Ramsay Healthcare, Woolworths, Qantas, Wesfarmers and WiseTech Global, among many others. And that's all for this Friday and this week. We hope you have a wonderful weekend. Stay tuned for our reporting season video on Wednesday. And as always, happy investing.